Sure. Hey, Stephen. It's great to have you on the podcast. Yeah, me and Daniel, we started this podcast around in October, and we have been working on getting multiple guests from like different fintech companies, mostly founders and even experienced professionals who have been working to scale up multiple startups. So happy to have you and love to know your journey and what do you do currently and how has been your career so far?
Yeah, and yeah, just to start it off, I guess maybe we could start like in the early days. Like I don't even know this, Steve. I've known you for years, but like why even get into like the world you're in of like finance and understanding the numbers and like what made you passionate about that initially? This would be a good place to just kick things off.
Sure, sure. Well, it all just started when my mom and dad met. They were both at Arthur Anderson early in their careers, and my dad was on the audit side, and my uncle Jim was also CPA and was a managing partner for Arthur Anderson for the West Coast for about 20 years. So, growing up in a house full of accountants, my cousins also were CPAs. So um, kind of felt a gravitas towards that for a long time. And when I was in college, discovered I had a real knack for mathematics and uh, considered a career in physics. And was heavily recruited by our college physics instructor to switch my major, and said, hey, got connections at NASA, we can get you into a graduate program and all that. And I kind of looked at that as a little bit of a chance, right? Because I knew the world of public accounting, having so many family members in it, and I felt a little bit more comfortable doing that. And I remember, being in my accounting courses, and we'd get in breakoff sessions, and I'd be able to walk around and kind of help all the groups figure it out. So it was something that came to me kind of naturally, and knew I had an aptitude for. So I liked the idea of going into public accounting because it was something that you need to be not only technically smart at, you have to have that real technical skill set, but at the tail end of your career, it is more business development oriented. And there's not a lot of people that I felt could do both of those and do them well. I was a math nerd. I loved the real technical aspects of it, but I was also a bartender and waited tables in college, and you just didn't find the people that kind of had both left brain and right brain that worked in that regard. So I kind of felt like this was going to be a great fit for me, and now 20 years later, I'm very happy that this is the path I chose.
So you're saying that it's like not just about the math side, there's also a social aspect with business development, right? So you're saying it's not just numbers. I mean, a lot of people think like accountants are just in their head all day, math equations, spreadsheets. I mean, that's probably part of it, right?
It is a huge part of it, but being able to kind of see the forest through the trees and take that technical code and then apply it to businesses and say, okay, well, you know where do we want to focus our efforts and energy to really make sure that that goes and helps our clients, and then taking the time to actually develop relationships with clients and understand what it's going to take to keep them there. Because if it's just about you putting numbers in boxes, then every single year you're going to be reproposing on your clients. Like, if you don't have a relationship with them, it's all about the price, and it's going to be like, okay, well, last year it was $11,000 for our tax returns. We have a new subsidiary this year. Like, give us a price quote. And if you don't want to be having to repropose on every single one of your clients, you better have a relationship with them. And then secondly, I think that a lot of what I've found is that over the years, growing the practice and doing what I do and being successful at it isn't, I mean, I always kind of think of it as external business development, but it really has become more so internal development and leaning into managers and staff and seniors and talking to them about, what their kind of inspired career looks like, and helping them get to where they're going and creating opportunities for them for advancement and putting them in positions to succeed, and kind of mentoring them. And again, that just all goes back to like soft skills, right? People skills. And that's where, quite frankly, I think there's a lot of great technical CPAs out there, but they can't do that part of the job. I mean, I've worked in enough public accounting offices to know.
I guess a question for Agam. Agam, what do you envision do you have any idea what a CPA is? Like, is this like most people don't know what CPAs are. I mean, this is an education, that word, just for like founders out there. Some of them may know, the newer founders may not know, serial entrepreneurs for sure know. Like Agam, is it something new to you? Do you know that word? Have you heard that word?
Yeah, that's what my question was going to be, and I just wanted to know in perspective of a co-founder or a startup person who wants to get their books running and do their audit, like what it's like and what role does a CPA or like accountant plays in scaling up a startup.
Yeah, well, you're not alone, Agam. I remember my wife, after many years, disclosed to me that when we were going on our first date, she had to Google what a CPA was. So it's not, you're not the only one, that's for sure. But within the world of CPAs, and when we graduate college with a degree in accounting, there's a lot of different things you can go into. Like, you can be a forensic accountant, you can be an auditor, you can be a tax professional, you can be a bookkeeper. I mean, you can do all these things. But long story short, when you graduate, if you want to become a CPA, you sit for a really robust exam that generally will take you about a year to pass. And in that is tax, there's audit, there's what we call FAR, which is financial accounting and reporting. There's a whole section on what we call BEC, but it has a lot of things on economy in there, which is kind of strange. So it has you learn in depth a very broad set of rules and technical subject matters. And then ironically, when you go into practice, you end up using, a very small portion of what you've learned. And I will say that going to work for a firm of, let's just say, 30 people, maybe there's one or two partners at that firm, versus going to work at Price Waterhouse is going to be just a completely night and day difference. If you go to work at PwC, you might only be working on hedge funds, or construction companies or whatever it is, but you're going to be working on depreciation for construction companies, and you're going to get to know the depreciation methods and rules really, really well for all of the heavy machinery and equipment. You get extremely good at a very small little technical piece of the pie. Whereas if you go to work for a firm with like 30 people, you're going to become a jack of all trades but a master of none, right? You're going to be working on partnerships, corporations, individuals, trust, estate, gift. You might be working on construction companies, tech companies, like whatever it is under the sun, you're going to be working on it. So somewhere in the middle is where you'd find companies like CLA. We're a top 10 firm in the nation. We're currently number 8. We're 8,500 people. We're very industry driven. So like, I'm the national tax leader for our tech industry practice, and I focus 90+% of my time on venture capital backed tech companies. So, highly specialized, but yet still working, on an engagement from start to finish. That's going to be the federal returns, the state returns. Maybe I've got, foreign subsidiaries, so I'm learning international tax laws and state tax laws and federal rules, and is that a proper method of accounting? So you have all the accounting methods that come into it. Whereas if I was working at PwC in the tech space, I'm not touching the state returns. You're just working on the federal return. If you're part of the SALT group, the state and local tax group, you're just focused on state local returns. And you have the international team. So you might have like 30 people working on one tech company or more. Like, I can only imagine how many people work on Meta's return. That, like, I would be lost if I was there, and they would be lost if they were here. So even within industry and firms of similar size, there can be a really big difference. And that's where I think that we go back to, do you even know what a CPA is? And then trying to whittle that down and try to, for companies and founders and, middle market tech companies, series B, C, D, E, like, for them trying to find the right CPA can be a very daunting task.
I think so. You work with venture-backed companies as a CPA. CPAs, I guess, you said that they go into a lot of different areas. For venture-backed CPAs, like, what made you go there? Is it like the adventure? like startups are fun, or was that like a path you felt like was right for you, or was just like there was a lot of opportunity there?
Well, couple things. I do think it is exciting. I think anybody that tells you that working in tax is fun and exciting is either one crazy or two lying to you. But this is about as not boring as it gets. I mean, just working with companies that go from 5 million to 50 million to 130 to 280 million year over year over year in revenue, and then watching that company as they go through their first year audit, and then they go IPO readiness, and then they're out on the market, and you're like, wow, I remember when I was working with a founder, right? Like, that's a pretty cool, exciting thing for us accounting nerds. I feel like there is some entrepreneurialism in what I do. Um, but a lot of times, in life we take what the defense gives us, and I spent a lot of years going out and meeting people at events, and happened to meet a specific woman who you both know well, and Anelia, and Anelia and I became connected at the hip from a networking perspective, and she got me connected with all the folks at Y Combinator, and as they say, the rest is history. So it was just kind of the opportunity that was there in front of me, and I had worked in a variety of industries at that point, but I knew a good thing when I saw it and just took it and ran with it.
Got it. So is the Y Combinator community, the startup community, I mean, you live in Silicon Valley, so you're, whether you like it or not, plugged in, because every event there's always like some founders there and some tech, companies. So it's kind of opportunistic in that sense, I guess. Right place, right time, right community.
No,
Uh,
absolutely, and it's crazy because like we all recognize we live in a bubble. Okay, I'm like, oh yeah, there's a ton of tech companies. Like, duh, Stephen. I don't think I'm allowed to curse on this, so I'll not say what I was actually going to try to
oh,
say.
good.
But I still get a phone call every year or so from some tax principal on the East Coast or something like, "Hey, one of my clients has a safe. Do you know what a safe? It's a simple agreement for future equity." And I mean, having been here for so long, you just want to ask, like, do you have a picture of the rock that you live under? Like, I'm curious how you're just now seeing this. But yeah, it just goes to show, this is the bubble that we live in, and what we see here and think of as commonplace is still not everywhere. And it is shocking sometimes to be reminded of just how much of a bubble we're in.
And for the community, a safe is an instrument to, like, I guess, raise funding on. One of many that you could do. But I think that being in Silicon Valley, a lot of people use safes, and Y Combinator uses a safe as a way to raise funding.
Yeah, I think they coined it back in 2013. And for those that are out there, I mean, one thing I want to I don't want to get too technical or into the weeds or anything, but this is something everybody should know, because one of the things that makes safes great is we're not setting a value on the company. It's not a priced round. So if you're going to raise like $5 million as a seed round, and that's on some sort of valuation, so let's just say we're going to put in 5 million, and we're going to give 10% for that, implying a value of $50 million for the company. Well, when we want to give people equity in the company, maybe a CTO type person, right? That we're just like, we got to have this guy. Or girl, we're gonna give them 4% of the company over the next 4 years. Well, it's like, okay, if based off that value, the company's worth 50 million. You do like what we call 409A valuation, and that kind of sets the value for equity based comp. And they start off with that. That's like the elephant in the room. They can't ignore it. Like, well, somebody just said the company's worth 50 million, and they whittle it down for like lack of control, lack of marketability. But they maybe get to the point that for the purposes of issuing shares, we're having to imply a value of $20 million for the whole company. And if you're going to give somebody 4% of the company, then you have to, recognize that as income, right? And so, forgive me, I think that's 800,000. Just doing the quick math. I told you I like math, but putting me to the test here. That's 800 grand of income. And so if we look at that same scenario, and we were able to raise that 5 million on a safe, a simple agreement for future equity, the amount of equity that those people are going to get in the future is going to be dependent on the Series A raise. Generally speaking, that's kind of how it's written on those safes. And so we haven't really set any sort of valuation in that regard for the company today. And so when you do like a 409A to establish the value of the company, you're no longer starting with this somebody just said it's worth $50 million, right? Based off the raise. Now you're just starting to look at it and go, okay, well, geez, the company's been around for 6 months and, they've got some money in the door, but they're still pre-revenue. And how do you really value IP that's not generating revenue yet? And maybe you're going to get to the point where you can get an independent valuation, that 409A that comes in and says, yeah, that company's only worth, $5 million right now. And that 4% of 5 million is, then looked at as dramatically less. Forgive me in the math. I think it's 200,000. And so now if we're able to bring somebody on board and they only have to recognize tax on 200,000 for the equity I'm giving them in the company versus tax on 800,000, that can be the difference between getting that person in the door and not. And so that's why we go back to these safes and we say, these things are amazing. They make it so easy for us and early stage companies to bring on critical key employees early on in the company's life cycle without killing them with the burden of a huge tax liability. So go safes.
And you brought up another point, and it's good to go into the weeds because this is more educational for like all the people listening. You brought up 409As. Like, is that something the CPA does? Is that something the accountant does? Is that something another firm does? Like, who takes care of that? Is it software driven? Like what is the process? And like, it sounds like you're involved in that process.
Yeah, I've gotten to know it fairly well, but if you ask me to do one, I candidly don't know how to do it. But CLA as a firm of our size, right? We got 8,500 people. We have a whole group that does 409As. But we saw a big change like 10 years ago in who does 409As because Carta came on the scene and Carta started doing these kind of cookie cutter 409As. And I forget what they charge now. I think it's like $2,500. I think it used to be less, but maybe they're more now. I can't recall, but having not ever had to be a paid subscriber of Carta. But in any event, a lot of law firms were doing them beforehand. CPA firms can do them. But if you're an early stage company, you don't need all the bells and whistles and a custom 409A. You can use Carta and it's still going to come out like pennies on the dollar. But like when you get larger and those 409As become more complex, and by using a firm that really knows the inside and out of them, we can get your 409A down to $6.26 a share instead of $7.87, and so on and so forth. It becomes very valuable to pay a professional services provider, whether it's law firm, CPA firm, to really do a proper 409A instead of just continuing to utilize Carta.
And that's an internal valuation for tax purposes. So it's not for public companies, right? It's only for private companies, a 409A.
Right, because public companies, the fair market value of the shares is based off the market. But if I'm going to work for Just Paid or whomever, and you guys are going to provide me stock as part of my equity-based comp and that's something I should specify. A 409A is, in the umbrella of valuations that are out there, it's a very specific one, and it is specifically used for equity-based comp. And it tells me how much, because if you tell me, Stephen, I'm going to give you $100,000 for coming on board as being our CFO, but I know you're worth way more than that. Thanks. And you're going to offer me some stock in the company valued at 200,000. We need a way to value that, and that's what that 409A comes out and says. Oh, well, our shares are worth $1 a piece, and so when I get those 200,000 shares, just like when you give me 100,000 cash, I gotta pay tax on that, and so I'm paying taxes on 300 grand, and that's where I better have some money saved up. And this is a crazy example where you're giving me $200,000 in equity and 100,000 in cash. We don't usually see it quite that crazy because who's got the money to pay the taxes on the 200 grand, right? So, but I digress.
Got it. Agam, do you have questions? And we're kind of going all over the place in terms of like startups and that sort of things, but this stuff Stephen probably deals with every day, honestly. So any questions?
So yeah, great to hear your thoughts on being like working in a startup and helping to scale them. Like, I just want to know what kind of daily problems you deal with. Like, you have been working with larger organizations, working at PwC. What's the difference between, working at a larger organization, working on their accounting, audits, tax, and working on the really small companies who are like Series A. And what's the difference between both, like on the books? What do you see, like on a high level overview of what they are doing and how they are performing? How do you evaluate that? Like, do you help with them on, you said like about taxes? I'm going all over the place, but you can just give an overview of what's the difference.
Yeah. Yeah, so working with some early stage companies, which I still really like to do. I remember when I got into this like 10 years ago, and I was just working with a ton of companies out of YC. Got their first 5 million in funding, and we're off to the races. And you fast forward 10 years, a lot of them have exited, but the ones that are still around from that early batch, like they're all doing several hundred million a year in revenue. They're all have audited financials. We're doing the tax provision. They've got foreign subsidiaries, and we're dealing with transfer pricing reports for that, which kind of dictate how you have intercompany activities. So it changes as they grow. The issues we come up with for an early stage company, it is a lot of discussions on equity based comp and hey, should we do non-qual? Should we do ISO? Should we do restricted stock units? Why or why not? Or how do we get this guy in here? How do we have a founder that, out of the three co-founders, one of them's not working out. So how do we, remove this co-founder without having a negative implication on our qualified small business stock qualifications? So there's a lot of things like that in early stage companies, and you're working more with founders and educating them on just like the basics of accounting and being like, hey, you're eligible for an R&D credit and you can have a payroll tax offset on that and generate, because otherwise if you just get a credit, you're like, hey, I just raised 5 million. We're going to be in loss positions this year and next year. And then I'm going to raise 20 million, and then I'm going to raise 50 million. And I'm not going to pay taxes for a really long time. And so just kind of helping them understand like what they need to be looking out for and so on and so forth. And then usually they hire somebody that's, head of operations, and then it's a controller or VP of finance. Then finally it's a CFO, and just kind of working with people that have varying understandings of tax and accounting and sales tax and international, and just kind of almost being more of a coach and mentor and kind of helping them go through that process without making a ton of mistakes, and helping them understand like when they hire people in another state, or if they hire 30 contractors in Ukraine, does that create permanent establishment, and just kind of helping them through all of that to make sure that they don't create a world of hurt for themselves from a tax perspective. But then once they've kind of got raised that series B, C, D, E, you're dealing with a lot more sophisticated issues and problems, right? Is this a proper method of accounting? Are you on an impermissible method? Maybe maybe there was a company using a small or mid-sized firm, and they come over to us, and Deloitte's doing the audit and we're doing the tax provision and the tax work. And you're sitting there, looking at the tax provision, and Deloitte has an opinion on how we're following this particular ASC 740 or whatever it is. And you can get into some very complicated technical areas there. Doing a lot of like quality of earnings reports for companies that are looking to go through an exit, or they are looking to acquire another company or get acquired. There's a lot of M&A work involved in being like, okay, well, is this a tax-free reorganization, or should we buy a stock sale versus an asset sale? And, do we need to create a merger sub to accomplish this? And like, how does that all work out? 382 analysis for utilizing NOLs. Once they become profitable, are they limited by their ability to use some of those NOLs? Like, you start dealing with a lot more complexity, and you're no longer dealing with the founders, and you're not talking to them on a regular basis. It's all, but I've been talking to their CFO for 4 years, and it's just a whole different host of problems. And the teams get a lot bigger. But yeah, I mean, I really do enjoy the variety. But there's still a part of me that just loves working with a new startup. It's just kind of I don't know. For me, it's exciting, and and I relish that. Not just because it's simple, but because it is a little bit more personable when you're working with a founder and helping them get this thing off the ground, and it's cool. Whereas when sometimes you're working on a company that's doing $1 billion in revenue, and it's a whole, there's 12 people on the engagement, you kind of lose sight of that personal feeling and context to things.
Would you what are some of the pitfalls? Like it sounds like you deal with a lot of issues like founder conflict and how to, deal with that and how does that get resolved? It sounds like you've seen the successes, you've seen the failures across the board, a lot of them. You're kind of at like a step away. I think a startup founder is kind of in it and they can't see what's wrong sometimes, but you can. Like from the sidelines, is there anything that like is an indicator of success or an indicator of failure, or it's really random? Like and this is not advice for like any of the people here. It's more like just a perspective from Steven on just doing this for many years. But
If there's one thing I've learned is I can't pick the winners. I've had some that I just think, oh yeah, this guy's on top of it. This founder's amazing. They're gonna do great. And then 3 years later, I'm like, wow, they really haven't gotten anywhere. And then there are some where I'm like, well, that's a terrible idea, and they go from 30 million in revenue to 130 and then to 250 million, and I'm just like, really did not think that selling used sneakers was the right way to go, but okay. Apparently that's a thing now. Looking back at it, I was like, you guys are crazy. And now it's like a very large enterprise. So yeah, I really can't pick the winners, but I will say that I've seen a number of unfortunate circumstances throughout the years where, companies were looking to be acquired, and then at kind of the last minute, the LOI, falls apart, and all of a sudden, they've only got 2 million in cash left, and they need to fundraise immediately, and have to lay off half their workforce overnight to try and stretch that 2 million out as best they can and try to get a fund or a raise completed, and they run out of time and have to fold. I've seen that happen with good companies, and it's a heartbreaker because people put their, as you know, Daniel, having been a founder twice, you know how much effort you put into these things. That's a lot of nights and weekends and just grinding. I can only imagine the life of a founder. I would imagine it's like tax season hours, but all year for 5 years. So, and it doesn't pay well.
so you're saying always have cash in the bank. That's kind of the underlying thing I'm hearing. It's always have cash in the bank to protect your startup. At least the underlying thing is what you're saying, but it's not easy for the founders to always get just cash, like war chest of money, but it sounds like that's what protects from hiccups like that may happen.
Yeah, and it's being a good steward of your balance sheet. You want to have like a fortress balance sheet at all times, but candidly, it's not always something you can do. But one thing you can do, especially like with how we've seen interest rates rise so quickly, I I just had a lot of tax kickoff calls with our clients because it is that time of year. Which, by the way, thank you for scheduling this the day before the deadline. It's okay. All my clients are C corp, so there's not really a deadline for me tomorrow. But back to it. When we do these tax kickoff calls, we look at a lot of companies' financials. We pull them kind of ahead of the call and say, hey, yeah, I saw you guys went from 10 million in revenue to 30 million. We saw that you raised a Series B. We saw this, that. But to walk us through how was the year for you guys, and we look for changes, and do you need to start worrying about sales tax? Do you need to worry about this? One of the things I'll always pay attention to, especially this year, is, hey, you've got $5 million sitting in a Chase checking account. Like, do you just not want free money? Like, go take that and put it in a money market account. And it's like, you don't need to be a CPA to tell somebody that, but it's amazing how many times I saw that this year on all my kickoff calls. It's like, well, go get 5%.
Wow. Okay, so I guess the founders and the people running the company are so in it that they don't even consider the war chests and how to optimize for that.
Yeah, it's a big one. I mean, seriously, like if you're getting 5% on $1 million, that's 50 grand. And if you got 7 million sitting there. That's $350,000. That's another couple engineers, or maybe just one on Sand Hill Road because it's gotten crazy. But that could be a huge difference for the company. And yeah, sometimes people are like, oh yeah, you know what? We've been thinking and meaning to do that for 6 months, and I just haven't gotten around to it. And I'm like, it's fine, I'll wait. Just go online right now and do it. It'll only take you 5 minutes.
There are a lot of like startups actually working in that space now that like can move that money and put it in interest bearing accounts, which is, I think it's a whole new genre of startup I've actually seen, which is take that Chase bank account, which is basically zero interest rate, and then it'll give you 4% or 5%. And they take a small fee for like managing that, which is still worth it. It's really worth it because you get that huge amount.
I agree, and there is so many new applications, and I mean, with what AI is doing so far, it is crazy. What the like, just we're just now, I think, seeing some of the real capabilities and ways it's going to impact things. I mean, look at. I was just at a CLA owners meeting, and we actually have developed a CLA GPT, and we've dedicated $500 million to technological innovation over the next 10 years that we've committed at CLA. So we will not be ran over by the AI and technology innovation. And look, everybody thinks like, oh, it's going to replace our jobs. I think when the calculator came out, people were like, well, you guys are done, and then, oh, Excel came out, like, oh, we don't need CPAs anymore. And it's like, no, it's just changed how we've gone about doing our business, right? Um, when I talked to some of the partners that retired, recently, they're like, I remember back in the day, we spent so much of our time just like actually reconciling accounts, and it was more like debits and credits and all this stuff. And now it's really a lot more consulting and tax law oriented, and all these things. And so the profession has shifted a lot. But what we're going to see really quickly here is that a lot of the preparation of returns is going to be automated through AI. And again, that's not going to eliminate our jobs. It's just going to change how we do it. Rather than having somebody come out of college and spend the first 2 years just, putting the numbers in boxes and kind of getting a return to balance, a lot of that's going to be done through AI. Will kind of set up the return, and now their job will be to review it. I saw a really cool demonstration of this at my last owners meeting, and just seeing what they could do already was pretty impressive. So it is exciting to see how tech is going to impact, because in the past, I think a lot of tech impacted tech, right? You were creating SaaS companies, creating all this, and don't get me wrong, they went out and worked in other industries, but just seeing how AI is going to impact professional services. And then, I'll go in there and ask a question like, hey, what's California's apportionment methodology? And it's like, California uses the 3-factor apportionment method. I'm like, that is wrong. I'll ask it again, like, does California use single sales factor apportionment? It says, yes, it does. I'm like, all right, that's right. So I'm getting conflicting information. So I know that, it's kind of like that Cheez-It commercial where the cheese comes out and it's immature, and they're like, yep, not ready yet. Put it back in for another few weeks. It's the same thing. And now there's companies that are coming out that will go and test the output of the questions that you ask, to make sure that it's giving you accurate information. And then they have to ongoing do that testing ongoing, because as new information becomes available to the AI engine, it can start changing its answers. And so it's just kind of crazy to think how this is all going to come to be. And I think that, like I said, when I grew up, I mean, I've got my tax codes, my regulations, I got all my books, I got all the pages bookmarked. Like, I know how to go find the code sections that I want, and I'll still read them in my book. But the people that are 10 years younger than me, they're like, really? I just go on, to the website, see, RIA checkpoint, do my research on there. And I think that the people that come 10 years behind them are going to be like, really? I just ask CLA GPT and it spits out the answer. So it's definitely, things are changing. Things are changing quick, and it's been a really cool thing to see it all happen.
Yeah, I think it's interesting that it's awesome that you guys are building your own GPT, because it's a lot of firms are just, I would say, human driven, where they just have a lot of people. What made CLA like think like that? Was it like you and the team there like really thinking we have to think ahead and like get it ahead of this? Because a lot of accounting firms are just it's like a huge team of people like doing all of this work. What made CLA want to do that? Like, what was it? What was the driver?
Yeah, I would love to take credit for that, but no, I was not the driver. But we have our leadership team, which is headed by our CEO Jen Leary, who is just an amazing force in and of herself. If you guys haven't ever seen her, just Google a video of Jen. She is bottled inspiration. I mean, that girl is just high energy and authentic and genuine and amazing, and really a great visionary. And I think she basically just said, hey, we can either ride this wave or let it crash into us. And if we embrace this and we get ahead of it now, not only is this, because sure, you could not invest that $500 million over the next 10 years and let our current year profits increase, right? Like we're all taking a beating on our take home pay because we're investing a lot of our profits into this new technology. But she said, our job is not to maximize the profits of the firm today. It's to leave this firm in a better place when we leave and we retire than we had it when we came in. And that's our responsibility as owners. And so I think that they just said that, we're going to invest to make sure that CLA has longevity and is a leader for decades to come. And that involves getting in front of all this technology, because I think that there's a lot of smaller firms out there that won't be able to spend the kind of money that it's going to take to develop that type of technology to automate a lot of their processes in terms of compliance, whether that's tax preparation or on the audit side, doing some of the grunt work on the audit. And where is that going to leave them? If they don't have the money to develop it, they're probably looking to license it from other firms that have developed it. And so maybe there's a opportunity for us down the road there, but that's above my pay grade.
Awesome. Agami, you have questions?
Yeah, so yeah, when we're talking about tech, I think that's a great analogy you said, like, how the tech is transforming the way the CPA and accounting people do their work. So if you can just go deep into any one of your examples about like how you said about, getting your tax codes and getting your bookmarks, like you can ask directly to the GPT. But instead of that, like if any real life examples, like which you have encountered so far, or something which you have came across and you have really worked on with a startup or companies, and giving using a tech solution, you kind of made your job easy. Like just give if you have any experience in that, and if not, like how the experience you would like to have if tech has some solution on that.
Yeah, and we haven't really rolled out the CLA GPT fully yet. I mean, we have kind of a beta version. You can go and ask it some questions, but I'll kind of just go like back to that example at the owners meeting that I was at, where they had a bunch of different PDF documents. Somebody sent their W-2 and their mortgage brokerage statement and a K-1 and all these things and all different files. And we said, hey, CLA GPT, combine all these files and prepare the return with them. And it would go in there, drop it in the return, and say, oh, it would shoot out a thing. It's like, okay, returns correct, or prepared, and then say, okay, summarize the return for me. And they say, oh, well, this person has a big federal tax liability and they have an overpayment for California. And you could go, why do they have a federal tax liability? Like, oh, the person doesn't have enough withholdings. Okay, what advice would you give to the person? Like, I would encourage them to talk to the payroll department and submit a new W-4 to increase the amount of allowance or decrease the amount of allowances on their W-4 so that they have more withholdings from their wages. And it's like, I saw that. I was like, man, I'm not even getting that from my first year staff. So that was a real eye opener. And this is just in beta form. I mean, so it's just, I think that we're going to really have one of those moments, right? Like in our lifetimes, the advent of the internet when I was very young, seeing the iPhone come around and just how that, having a computing power in your palm really changed things. And now the advent of AI. I mean, I really do think that this is one of those life-changing moments that we're embarking upon.
All right, yeah, and another one thing which I usually come across, well, in terms of AI and GPTs, it's really tough to keep up the most updated information and training the model on the most recent updates. Uh, I see that, in tax and accounting, like, it keeps on changing years over years. Like, how do you train those models, and you need to keep up the models with the latest information. So do you think that's gonna be a barrier, or it's gonna be something which is gonna be very critical to the industry?
It's a great question, and I think that time will tell. I don't know if we're far enough along to really have a lot of great insight there. Um, but it is something that we're all going to have to adapt to. And I think that when we look about where firms are at today and where we're talking about being in 5 years or 10 years, that transition period is going to be anything but smooth. There is going to be, we'll call it a messy middle, right? Where we are now automating a lot of our processes, which is great. So, in the past, I had to have somebody prepare that return, and that staff, that bill rate, and adds to the WIP and all that. But now, sure, we've automated that process, but we then have to go in and clean it up because it's an imperfect process, right? Or it gave us the wrong answer. We continued on with the wrong answer, and was later discovered to be wrong, and now you have to amend a return. Oh, and also add in like how much money you've spent trying to build that software. So it's there are some things that it sounds great, like, oh, it's gonna save so much time, effort, energy, and cost. But I think that as we go along, we will eventually get there. But there's going to be a period of time in which we're not really saving any time, money, or cost.
I notice I'll give you one example where it saves me time. It's like I'll put a CSV file and it'll have all these columns, right? Like long columns, and I'll say convert this to rows, and it will just like literally, it's almost like an Excel sheet with really smart stuff. That's one really interesting thing that it does, is just like reformat things. And I'm sure you get really messy stuff all the time. Well, maybe you don't, Steve. I don't know. Maybe your team cleans it up for you, but I'm assuming that CLA like does a lot of the cleanup for startups. Like they probably give you really messy stuff and you're like, this is not usable. And then you have your whole team like help train their startup on that. I mean, is that the case? I'm just assuming that happens.
Yeah, there's some truth to that. It's like in the world of bookkeeping. I always say, I'm like, there's no such thing as a good bookkeeper, just a bad accountant. Generally, it's a lot of people I know that worked in public accounting for a year or two that didn't really kind of work out, ended up becoming bookkeepers. I'm like, hey, I wonder what John's doing. I haven't, and I'm like, oh, look, he runs a bookkeeping practice. I'm being sort of joking. There are great bookkeepers out there, but yes, a lot of the times our process is getting things cleaned up. And I imagine that that's kind of a human element that maybe at some point it's hard to understand exactly how technology is going to help in some of these areas, right? Like H&R Block, those very simple returns, I would imagine that to some extent those days are numbered, right? Like AI should be able to handle putting a W-2 and a brokerage statement and a mortgage interest statement and property taxes into a tax return and prepare it 99% of the time 100% accurate, right? But when you're talking about a tech company that is doing 30 million in revenue, has 20 million in expenses, is in the next year it's 50 million of revenue and 40 million of expenses, right? They're filing in new states because they've got economic nexus. They've hired more people in more states. They're setting up a foreign sub over here. We're trying to figure out how to handle the transactions between US Co and foreign sub, and then US Co wants to set up another subsidiary or hire or acquire a subsidiary, and should they file on a consolidated basis, and can we use the NOLs from the subsidiary to offset the profits of our parent company? Why or why not? Like, that's going to be a while before AI can really go in there and help, but certainly could probably come in and help with some of the preparation parts. But yeah, there are things that like I'm thinking in my mind that AI might never be able to do, but maybe in 5-10 years, it's closed the gap a lot more. It's crazy to see just how quickly it's been able to evolve. And I don't want to be get us into the political realm of things, but I hear all the time more discussions about political leaders saying we need to regulate the tech industry and how they've been able to develop AI and put safeguards in place so that Terminator 2 Judgment Day doesn't come around, which I think that's more science fiction than real reality, but nonetheless, we're in for an interesting ride in the next few years.
I think I cut you off, Agam. You had another question.
Yeah, I mean, we are closing to the hour, so I just have one question for you, Stephen. Like with all the information, experience, and knowledge you have right now, if you have to restart your career from the day you started it, like what would be something you will focus yourself in terms of industry knowledge or some particular direction you would want to move forward? Just a question for someone who is just starting their careers in uh like accounting, and like some advice on where they should focus right now. Like I see that a lot of things happening in tech, but apart from that, where do the focus should be?
Yeah, that's a great question. I mean, are you asking like if I was to come into public accounting today as a fresh college grad, like where would I say I should try and emphasize and go? Or if I was a college grad, should I even go into accounting, or should I become an engineer or a nurse, or what? Maybe clarify the question.
Yeah, so if you have to start off your career as a public accountant all from scratch, like with all the information, knowledge, and experience you have right now, and someone you like, someone who want to, have a career in that, where would they start from?
Hmm. Yeah, if I was graduating today, I'd probably look to get involved with um, larger, more complex entities, and that's probably going to lead me down the road of like the Big Four or at least a top 10 firm. Because, like I said, I do think that a lot of the smaller firms that really just focus on compliance and don't add a lot of value through consulting, like you find at CLA or PwC, right, where they're working on finding you know little tiny piece of the tax code that says and instead of or, and that enables us to have a different methodology for apportioning income to California, and takes our California net income from 50 million down to 10 million at a net savings of 9% of the tax rate. Is on $40 million is going to be $3.6 million of tax savings. Like getting into the consulting aspect of things, where you're really reading and applying tax law, I think is an area that I would probably look to focus on if I was coming out today, rather than focusing on some of the smaller firms. Because I worked at smaller firms earlier on in my career. I kind of just kept working at larger and larger companies, which I think is great because it gave me a very well-rounded experience in tax and public accounting. But yeah, if I was coming out today, I'd focus on those large multinational businesses, because again, I am a little scared of AI and how it's going to impact and replace some jobs, the lower level jobs. But I do think that those higher level consulting heavy, real complex tax structures, that's where that's kind of where it'd probably be the safest landing spot.
Really good advice. Really, really good advice. Awesome. I guess last thing for you, Steven, since we're at the end of the hour, if people wanted to work with you or your firm, like where do they go?
You can actually go to our website and put in a web inquiry. You can also just directly reach out to myself. I don't know if my information just magically pops on the screen. I don't know where AI is when I need it. But yeah, if you go to claconnect.com, you can totally go on and put a web inquiry in, and you just kind of say like, hey, this is my company, this is the industry that we're in, and this is the issue that we're having, and it gets filtered to the right group of people. So pretty easy to reach out to CLA in that regard. And again, it's very much an industry driven approach at CLA, because if you ask me to work on a construction company, I'm going to fail miserably. I am not going to be able to advise them correctly. Should you be on this method of accounting called cost percent complete? I can barely remember them. I have a lot of people that work in construction in this office, but there's like percent complete, there's long-term contract, there's deferral retention, all these different methods that you can be on as a construction industry taxpayer. And if you work with somebody that really knows those things, they're going to be able to find ways to defer taxable income to another year, or they're more aware of certain energy credits that you're eligible for and things like that. It's like, I'm not going to be able to serve those clients well. But so that's why we really say, in order for us to deliver on our CLA promise to know you and help you, we do so by becoming experts in the industries we serve. So, I speak SaaS, right? I speak qualified small business stock. I know the ins and outs of equity-based compensation. We become experts so that we can truly go to market, help our clients do so in an efficient manner, and really help them go from like incubator all the way to IPO. And that really enables us to go from your accountant to your trusted advisor.
Awesome. Well, thank you so much, Stephen.